There's a story Americans tell about wealth. Stocks are paper, real estate is real. Your grandparents bought their home for $30,000 and now it's worth $600,000. The story is partly true and almost entirely missing the math. In April 2026, the median home in America costs $408,800. The 30-year mortgage rate is 6.3%. The price-to-income ratio just hit a record 5.08. Today, the language of the oldest debate in personal finance. Welcome to Fiscal Fluency, the language of wealth. Real estate versus stocks isn't a religion. It's a comparison of return, leverage, cost, and time. Per dollar, per year, per hour of your attention, which one actually builds wealth faster? Start with the numbers. The S&P 500, from 1928 through 2024, returned about 10% per year, nominal, roughly 7% after inflation, including dividends. Almost a century, through the Depression, 2 world wars, and 14 recessions. Now, real estate. Robert Shiller, the economist who built the Case-Shiller Home Price Index, has documented U.S. home prices going back to 1890. Inflation adjusted, the long-run real return on a U.S. house is under 1% per year. Nominal, 3 to 4%. A house, over the very long run, has barely outpaced inflation. That sounds wrong because the headline leaves out two things, leverage and rent. We'll get to both, but on price appreciation alone, stocks have beaten houses by a wide margin for over a century. Here's the lever. Buy stocks, you usually pay cash, $1,000 in, $1,000 at risk. Buy a house, the bank lets you put down 20%. So $80,000 of your money controls a $400,000 asset. If that asset rises 4%, $16,000, your return isn't 4%. $16,000 on your $80,000 of equity is 20%. That's the leverage effect. And it's the single biggest reason real estate has built so much middle-class wealth in America. But leverage is a knife with two edges. The same math runs in reverse. If your house drops 8%, that's a 40% loss on your equity. In 2008, U.S. home prices fell about 27% peak to trough, and roughly 1 in 4 mortgaged homes went underwater. And the leverage isn't free. In 2026, the average 30-year fixed mortgage is 6.3%. Over 30 years, on a $400,000 loan, that's roughly $488,000 in interest. You don't just owe the price of the house, you owe the price of the money. Stocks have one cost, an index fund expense ratio, often under 0.1%. That's it. Real estate has a list. Property tax, typically 1.5% to 3% of the home's value every year. Homeowners insurance, 0.5% to 1%. Maintenance, the well-known 1% rule says budget 1% of the home's value annually. HO fees in many markets, vacancy and management if it's a rental. Added up, between 3 and 6% of the home's value disappears every year just to keep owning it. On a $400,000 house, that's $12,000 to $24,000 a year before the mortgage payment. And then the exit tax. Selling a stock costs you a few cents in spread. Selling a house costs you roughly 6% in commissions in closing, $24,000 on a $400,000 sale. The reason serious real estate investors don't lose this argument is rent. A house that appreciates at 4% and pays a 5% net rental yield delivers a total return in the high single digits. Add leverage, and a well-bought rental can hit the low teens. The problem, in 2026, gross rental yields in most major U.S. metros are sitting around 4 to 6%. Subtract operating costs, vacancy, and the mortgage, and net cash flow on a newly bought rental is often near zero or negative. Real estate as a wealth engine works, but it works on the deal you bought, not the deal you read about. 3 things stocks quietly win on. Liquidity. You can sell your S&P 500 position in seconds. Selling a house takes 30 to 90 days, costs 6%, and depends on a buyer existing. Diversification. One share of an index fund holds 500 companies across 11 sectors. One rental property is one building in one zip code. If the major employer leaves or the school district turns, your portfolio is one street. Time. Index investing takes about 30 minutes a year. Set up auto contributions and ignore. Owning a rental is a part-time job. The honest comparison isn't return per dollar, it's return per dollar per hour of your attention. There's a way to own real estate without the operational pain. A REIT, Real Estate Investment Trust, is a publicly traded company that owns property and is required by law to pay out at least 90% of its taxable income as dividends. You buy them like stocks. The FTSE Index, the standard REIT benchmark, has actually outperformed the S&P 500 over 25 and 50-year windows. Self-storage REITs alone have averaged nearly 16% annualized over the last 3 decades. Most people who think they want real estate actually want REITs. A quick note on what's actually happening right now. The median U.S. home in March 2026 sold for $408,800. The price-to-income ratio is 5.08, the highest in the modern dataset. Households earning $75,000 can afford about 21% of listings, down from 49% in 2019. The leverage advantage of real estate is mathematically still there. The price you pay for it is at a multi-decade extreme. 3 rules. 1. If you can't quote a specific property's expected cap rate, net of taxes, insurance, maintenance, and vacancy, you're speculating on price, not investing. 2. Most people who think they want real estate actually want REITs. Same exposure, none of the operational job. 3. For most people building wealth from earned income, the answer is index funds and tax-advantaged accounts first. 401k, IRA, HSA, then a primary home you can afford, where the wealth comes from the forced savings of paying down the mortgage. Investment real estate beyond that is a job. This is education, not financial advice. The right mix depends on your income, taxes, and how much of your time you want to trade for return. Run your own numbers and talk to a fee-only fiduciary before making a 6-figure bet. Next up, the 4% rule, the single number that decides when you can stop working. Hit subscribe so you don't miss it. Stay fluid.